Today, Governor Lowe and the Reserve Board met for the final time in 2019 and they kept the cash rate on hold at 0.75 of 1%. Now, 2019 saw 3 rate cuts over that time. And what's interesting about that for all of those people who love the data is between August 2016 and May 2019, 34 months, the cash rate was on a hold at 1.5%. So they've definitely tried to stimulate the economy, but they haven't seen the bounce that they were looking for yet. And so there's still potentially more work to do in 2020. Most economists and forecasters are thinking maybe 1, possibly 2 rate cuts next year, and I'll talk a little bit more about quantitative easing or some other unconventional monetary policy measures that the RBA are looking at when I get into our own backyard. But first, because there's lots to get through today, I want to look at global markets. So obviously the US and China trade deal continues to dominate in regards to economic activity and economic sentiment. There's still a hell of a lot of posturing going on, not helped by President Trump's recent signing of the pro-democracy protesters in Hong Kong. So that's put a little bit of spanner in the works. But again, I'm confident that we will see a deal very, very soon, because the president needs his US economy to be firing for his re-election chances next year. Speaking of the US economy, GDP was upgraded from 1.9 to 2.1% for the September quarter. That's a positive story. Personal incomes were flat in October, and it is the weakest result over the course of the year. Interestingly, business spending on the back of the pending US trade deal, which Trump says we've got a deal, sort of haven't got a deal, we have got a deal, there's going to be a deal, has seen a spike. And so that's good. So basically, non-defence capital goods orders are up 1.2%, and that's the strongest increase in business spending since January of this year. Also, we saw during the month of November that Jerome Powell confirmed the guidance from their Fed Reserve in regards to a pause on any further easing on monetary policy there in the United States. So that's where their story starts and ends. So not a bad story for the US at the moment, but could be better if we see a trade deal get over the line. Turning our attentions to the world's second biggest economy, China. Their manufacturing PMI rose to above 50. We were the reading of 50.2 in November. It's the first reading above the neutral setting since April of this year. And also non-manufacturing confidence also rose to 54.4, and that's the highest reading since March. Now, that obviously tells us that the stimulus that the government introduced several months back in China is doing something to lift the Chinese economy. It's not doing a huge amount, but there's still positive news there in terms of when we talk about China. Turning our attention to the Eurozone, the Euro inflation data came out and expanded faster in terms of rising 1% over the year to November. Now that's a positive result considering it's up from 0.7 of 1% in October. So it still remains below the ECB, which is the European Central Bank's forecast, where they'd like to see it. It was just under 2%, but it's heading in the right direction. So that's not a bad news story for the Eurozone. In terms of Eurozone unemployment, again, another positive news story here, that the unemployment rate fell to 5.7% in October, and that's the best result since July of 2008. So hopefully more news, good news story there. Finishing off the good news story of the Eurozone, still not, smashing it over there, but still positive stories. GDP growth grew by 0.2 of 1% in the third quarter. Key surprise here was actually Germany's expansion. It grew by 0.0 of 1% for the third quarter, but that meant that it avoided, because they had a negative quarter of growth the previous quarter, so that meant that they narrowly avoided a technical recession of 2 negative quarters of GDP. Rounding out our global trip, UK going to the polls on the 12th of December. Looks like Boris Johnson will get re-elected and have his mandate for them to exit the EU. So time will tell. in terms of what plays out there when we look at the global story and the story in the UK. Now let's turn our attentions back home. We'll start with probably some of the biggest news stories of the month, and that was around the monetary policy, the statement of monetary policy there. Now this confirmed that the RBA had once again downgraded its near-term outlook for the economy. So we'll get through some of the numbers now. The RBA expected GDP growth to be 2.25% in 2019 and 2.75% in 2020. It expects inflation to remain below its 2 to 3% target band until December 2021. Turning the attentions of monetary policy forecast for the labour market, they now expect unemployment rate to remain steady at around 5.2% until it begins to drift lower in mid-2021. Not next year, mid-2021. So that's important to know, where it's then forecast, in their view, to reach an unemployment rate of 4.9% by December 2021. So obviously a bit of work to do there in regards to stimulating the Australian economy. And I think the Liberal Party have some work to do federally in terms of also playing their role in getting some stimulus out there in the market. Now the other big news came last week, and that was when we heard from Dr. Philip Lowe in regards to unconventional monetary policy speech that he delivered last week. And this speech was very interesting in terms of, he shared his views in regards to the observations of what quantitative easing and different sort of unconventional monetary policy stimulus that has occurred globally since the GFC has done. And so we got some really interesting insights in regards to that. And then he was pretty transparent in the way in which he talked about how quantitative easing and what sort of opportunities he saw for the Australian market. And so he stressed, and I want to stress this point, that he sees no need for any type of unconventional monetary policies until the cash rate gets to 0.25 of 1%. Now remembering, we're currently at 0.75 of 1%, so that's potentially two for the rate cuts that we might see next year. Now he also said that he didn't believe that there would need to be any sort of unconventional monetary policy or quantitative easing or anything like that in the near future. So he's basically trying to signal to the market with his forward guidance around the fact that the economy's still going okay. And when you do look at our numbers compared to other performance of established and developed economies, our economy's ticking along well, but we are definitely recognising that their situation of low growth environment and low interest rates are here to stay. And you saw that, what I just mentioned in terms of the statement of monetary policy in terms of our forecast for growth. The other important things that he also talked about was when the economy is persistently moving away from the target objectives of low inflation and low unemployment. So he's basically saying that these are measures that he doesn't necessarily want to introduce unless they foresee that they absolutely needed to do so. Now, in terms of the stimulus that he would like to introduce, he was very clear in regards to what that stimulus would be, and that was around buying government bonds. Okay, so instead of doing negative interest rates, which there has been a lot of talk about negative interest rates, printing cash, those types of things, he's going to avoid those types of policies and focus on buying government bonds, which has a flow-on effect in terms of asset stabilisation, and then also decreasing interest rates in terms of the cost of money as another means to do that, other than just touching the cash rate. So we were pretty clear in terms of the agenda from the RBA and the thinking from Dr. Lowe in regards to his position around how we might further stimulate the economy through monetary policy in the event that we need to do so. But again, he also stressed only in the event that we need to do so. So that's the sort of two big stories from the RBA in regards to their positioning and posturing for the last 4 weeks. The Aussie dollar, I want to sort of start with that, continues to slide against the US. It's obviously good news for our businesses that are exporting, also those who get paid in US dollars, such as our great businesses like CSL, some of our mining, and I think even Cochlear also earns a lot of their money in terms of US dollars. So that's good for the economy. I'd also like to think that it would encourage the Aussies to actually holiday at home and spend some of their money here, and the domestic economy would also boost our GDP and also employment opportunities. So go on holiday in Queensland, everyone, or wherever you need to holiday, Perth and so forth, Western Australia, great places to visit. And also, why not take a couple of domestic holidays over the Christmas and festive season? Get involved in that. Now, in terms of the equity markets, obviously, good news here is we've hit a record high in our equity markets. Combination of obviously money needs to be deployed somewhere when we're getting very, very low bank returns in terms of our interest that we earn on savings. So some of that money has flowed into the equity market. So we've now surpassed our record highs of 2007. So the equity markets remain strong in Australia, as they do in the US and some other developed nations around the world. I'm now turning my attention into business sentiment. It did improve in October, but still remains below its long-term averages. So the NAM monthly business confidence index rebounded from a 0 reading in September to a reading of +2 in October. And conditions, in terms of confidence and conditions, also registered a 1% point increase to record 3. So that's in terms of current conditions. Now turning our attentions to unemployment, we saw there that it wasn't necessarily a great result for our October numbers. So we did actually have job losses of 19,000 jobs in October. Now this is interesting in terms of it followed a revised 12,500 increase in job numbers in September, which basically meant that our unemployment number in September moved from 5.3 down to 5.2 based on this revised number from the ABS. But obviously these job losses also then moved that unemployment number back to 5.3%. Now it's the worst result since August of 2016. So full-time jobs fell by 10.3 thousand, and there were 8,700 fewer part-time positions. Skilled vacancies also fell in October to 10th consecutive month of decline. So we need to do something there. And we just saw yesterday that the ANZ job ads were released, and it showed the Australian job advertisers on newspapers and internet declined by 1.7 month on month in November compared to market sentiment. So the market consensus was that job numbers were going to fall by 2.2%. So although not a good number, not as bad as what the economists were thinking. And that was obviously after a fall of 1% from the previous month. So that's our unemployment story. So that would be playing on the minds of the RBA, but in this particular case, not enough to change their rate in terms of keeping the cash rate on hold in December. Now, wages growth. So wages grew at a rate of 0.5% in the September quarter, and that was the same as the June quarter, which brings our annual rate of growth down to 2.2%, and that's the lowest since June of 2018. Now, I do have a message here, however. We have been focusing on this low wage growth, and yes, it is low considering our long-term trends of 3+%, but we also need to be reminded that inflation is considerably lower than its also historical long-term of 3 to 3.5. So if our inflation rate is 1.5 to 1.6 and our wage growth is 2.2, we're technically still net better off in terms of if costs of living aren't going up. Now, obviously you can argue, and it's a fair argument, in regards to energy costs, and certainly health costs have gone up and food costs through the drought. So we're not necessarily seeing that play out week to week, month to month, but it will play out over time. If inflation remains lower than wages costs, we're still technically in a better position. Hopefully the drought will break. Hopefully our governments will organise our energy policies and introduce nuclear and make our energy costs cheaper, in my view, and that should flow through the economy over the coming decades, which will also be a good thing. Now, I wanted to just finish out before I talk about the property story around the MyEFO, which is basically the mid-year economic and fiscal outlook. that will be available. Last year it was available in December, but that's not coming out until January. So certainly the RBA and all economists will be interested in terms of how the economy has performed in the first half of last year, and this is basically checks in on the budget. So this is when we will see a surplus being recorded, and that the economy is back in surplus. So the Liberal Party will score their political points, which will annoy us all, but it will happen, and then hopefully we'll then see them being sensible around bringing some further stimulus into the economy, which we absolutely need from a fiscal standpoint. You know, some of that stimulus absolutely needs to be things like new start allowances need to increase. So hopefully we'll see a bit more stimulus coming in from the fiscal side of the fence, as opposed to all of the effort being on monetary policy at the moment. So that rounds out the economic outlook. I'm now going to talk about the property story. In regards to the property story, I'll start with credit and lending. So private sector credit slowed in October to just 1% growth. It's the weakest reading for 4 months. Business credit also contracted 0.1, first decline since January 2017. And it does, you know, sort of correspond to a little bit of a fragile weakness in terms of business confidence and business investment. So we need to do more there. In terms of housing credit, this is a positive news story. So it picked up a touch to be up 0.2 of 1% growth in September to a 0.3 in October. I do suspect that this number will increase given the results I'm about to share with you in regards to what's happening in the housing space in terms of prices. So I think that data number will pick up. In terms of building approvals, we did see those results come out also yesterday, and we saw a decline in approvals of 0.8 of 1% in October. Now that represents 23 months of declines after peaking from our last property boom. So that is standard in terms of how the cycle moves. Obviously the headwinds there still remain in the medium and high density construction, and the confidence that is playing out, or the lack of confidence is playing out in that particular space. So that's something to watch, but I do expect house and land packages and freestanding construction to improve now and also into 2020 as property prices continue to move up and first home buyers start to enter the market with some of the stimulus that's also coming out in regards to federal government and also the state government incentives. So that sort of plays that story. Now finally, CoreLogic released their results for November. Again, very, very positive property price results. 5 months now of national price growth after bottoming out. Sydney, an incredible 2.7% growth for the month. Melbourne, not far behind, with a 2.2% growth for the month. So over the quarter, Sydney is 6.2% up, and Melbourne then trumps Sydney at being 6.4% up for the quarter. Now you can get all those great results from CoreLogic. I just want to read out the quarterly numbers. I'm not so wedded to monthly ups and downs. It's the quarterly result that I'm keen to look at. So Sydney again, Sydney quarter 6.2% up, Melbourne quarter 6.4% up, Brisbane quarter 1.8% up, Adelaide 0.9 of 1% up, Perth negative 0.9 for the quarter, but a positive news story for Perth. We saw a positive growth of 0.4 for the month, so good story there. Hobart still going up at 2.8%, Darwin negative 1.1% for the quarter, and Canberra also having a good result, being 3.2% up for the quarter. So combined capitals 4.6% up, combined regionals 1.1% up to the national overall price growth, I should say, at 3.8%. So some of the highlights, obviously best performer Melbourne at 6.4, weakest performer Darwin at negative 1.1. Highest rental yields still remain Darwin, with their obviously very low valuations are up in Darwin at the moment, 5.9% yields. Lowest yield is Sydney at the moment at 3.1%. So some interesting numbers playing out there. So my final message for the year, as I round out 2019, is it's very clear that economic sentiment is now weighing in regards to the negative side. The news and the media cycle is on the back of that, which I do think is fair enough. You know, the economy is underperforming in regards to what's happening there, and the consumers are more broadly concerned in regards to these, historical low interest rates and what that means for them. So I think that's a valid message. But I also want to remind people that in terms of that message, that the money's not coming out of the economy. By that I mean that if you're employed and you're receiving your money, what's happening to that money? It's hitting the balance sheet somewhere. And so if people aren't spending, effectively what it's doing is reducing household debt, or if you don't have any debt, it's actually increasing household savings. So I think we can't lose sight of the fact that money is still flowing in the economy. It's just not flowing in the spending side, which is not growing. GDP is made up of 60% of consumption, okay, and that's where we're seeing less consumption. But what it does mean that if we've got record household debt, okay, and we are paying some of that down, that actually means we're paying less interest. And so if that continues over the course of the next 12 months and our household debt levels start to decline, or our household levels, saving levels improve, at some point into the future, consumers will come back out and they will spend. And so if the government can stimulate that after, we consolidate a bit of debt, and it might take 12 months or more, then the economy is going to do a fairly good job of rebounding. Because again, the money is not going nowhere, all right? It's going into paying debt down or going into savings if consumers aren't spending. So it's my view that we may still see historically low interest rates for the long term. That's true. But I still think we will see more uplift when it comes to the economy after this flattening period. So I'm still quietly optimistic in terms of what's going to happen into the new decade. And as we turn that decade over, and we know that obviously the Reserve Bank will take a break, as they do in January, and they will look at the data. So, starting with how well the Black Friday sales went at the end of November, and then what sort of, consumer consumption's happened throughout the course of the festive season and into the Boxing Day sales and the travel and also the expenditure that's going on in the economy. And they'll regroup and have a look at the data in February and then basically make their points. So what does that mean? It does mean we're probably going to see at least one more rate cut, possibly a second rate cut before the middle of next year. Most economists are tipping that first rate cut will come in February. That's okay. In terms of my understanding of this is I still think longer term, as I said, the economy is growing, population is growing, and if we're not spending that money, we're saving it for a rainy day, and that rainy day will come and we will spend it. So, as I send the final message to you, I hope you have a great Christmas and festive season. Stay safe, stay happy, and remember that knowledge is empowering, but only if you act on it. Until next year, I'm signing out.